A senior Federal Reserve policymaker has just said out loud what most central bankers spend their careers avoiding. He does not know whether interest rates are high enough. Speaking to the Wall Street Journal in an exclusive interview published on Friday, the 31st of July 2026, Richmond Federal Reserve President Tom Barkin described the question of whether policy is restrictive enough as, in his words, a close call. That is not a throwaway line. It is a serving policymaker telling investors that the committee setting the price of money for the world's largest economy is genuinely split on direction. Within hours, the comment was carried by FXStreet, investingLive, TradingView, and CryptoRank. Today, Sunday the 2nd of August 2026, that single phrase is still the most quoted sentence in global markets, and it is shaping how traders will position when trading desks reopen tomorrow morning. Tom Barkin has led the Federal Reserve Bank of Richmond since 2018, and he is known for careful, evidence-led language rather than dramatic statements. So when he frames the rate path as a close call, the phrasing is doing deliberate work. It signals that the case for holding policy where it is, and the case for tightening further, are close to evenly balanced in his own assessment. Crucially, his stated reason is inflation uncertainty. He is not saying inflation has been beaten and the debate is only about timing. He is saying the committee cannot yet be confident about where price pressures settle. That distinction matters enormously for markets, because it removes the comfortable assumption that the next move must be downwards. When a policymaker refuses to rule out that rates are still too low, every subsequent inflation print becomes a potential turning point rather than a formality. Barkin's comments did not arrive in isolation. On Friday, the 31st of July 2026, Forex Factory reported on Fed dissenters explaining publicly why they backed higher interest rates. That is the detail many casual observers missed. Dissent at the Federal Open Market Committee is not unusual in itself, but the direction here is the story. For much of the past 2 years, market pricing has assumed the argument inside the Fed was about how quickly to ease. Officials formally breaking ranks to argue for tighter policy flips that assumption on its head. It tells you there is a hawkish bloc that believes the current setting is not doing enough to bring inflation sustainably back to the 2% target. When you combine an openly hawkish dissent with a centrist voice like Barkin's calling the decision a close call, the balance of risks inside the committee looks very different from consensus expectations. Strip away the personalities and the genuine dispute is about how much of recent inflation is temporary and how much is embedded. Restrictive policy works with long and variable lags, which means the Fed is always steering by a rear-view mirror. If the hawks are right and price pressures are sticky, holding rates steady today quietly loosens policy over time as inflation expectations drift higher. If the doves are right and the economy is cooling faster than the data shows, every extra month that elevated rates risks pushing unemployment up unnecessarily. Barkin's honesty is essentially an admission that the incoming data has not yet settled that argument. For anyone reading Fed commentary, the practical lesson is this. Stop treating a rate cut as a scheduled event on a calendar. Treat it as a conditional outcome that depends entirely on the next few inflation and labor market releases. The currency market reaction shows how tangled this has become. Reporting on Saturday, the 1st of August 2026 noted that the United States dollar index has been struggling near the 100 level following suspected Japanese intervention. That is significant on two fronts. First, suspected intervention means Japanese authorities are believed to have stepped into the market to defend the yen, something they only do when currency moves become disorderly. Second, a dollar index hovering around 100 rather than surging tells you traders are not fully pricing a hawkish Fed, despite the dissents. Normally, rising expectations of higher American rates pull capital into dollars and lift the index. The fact that it is stalling suggests the market is treating Barkin's close call as genuine two-sided risk rather than a firm hawkish signal, with intervention risk capping the move. You might reasonably ask why a Richmond Fed president matters to someone in Manchester or Cardiff. The answer is that American rate expectations set the tone for global bond yields, and UK fixed mortgage pricing is driven by swap rates that track those yields closely. If markets rebuild expectations of higher for longer American policy, gilt yields tend to follow, and lenders reprice fixed-rate deals upwards even when the Bank of England has not moved. The currency channel matters too. A weaker dollar makes sterling relatively stronger, which slightly reduces the cost of dollar-priced imports such as oil and many commodities. Savers face the mirror image. Persistent uncertainty about the peak in rates is exactly why the best fixed-term savings deals have not disappeared. In short, an ambiguous Fed keeps British borrowing and saving rates higher than a clearly dovish Fed would. Near term, three things will decide whether Barkin's close call resolves upwards or downwards. First, the next American inflation readings. If core inflation accelerates, the hawkish dissenters gain the upper hand and rate cut pricing gets pushed further out. Second, the labor market. Clear evidence of cooling hiring gives the doves the cover they need. Third, currency stability. If Japanese authorities intervene again and the dollar index breaks decisively below 100, imported inflation into the United States could ease, quietly doing some of the Fed's work for it. Expect more public speeches over the coming days, because when the committee is this divided, officials tend to argue their case in the open. The realistic base case, based on what has actually been said this week, is a hold with a hawkish tilt rather than an imminent cut. Here is the memorable point to carry away from today, Sunday the 2nd of August 2026. When a Federal Reserve president publicly says it is a close call whether rates are high enough, and colleagues are formally dissenting in favor of tighter policy, the market's assumption of a smooth path down to lower rates is not supported by the evidence. Uncertainty is the message, and uncertainty has a price. For borrowers, that argues against gambling on imminent relief when fixing a mortgage. For savers, it means competitive fixed rates are likely to persist a while longer. For investors, it means volatility around every inflation release rather than a steady drift. Barkin has essentially told everyone to stop forecasting and start watching the data. That is unglamorous advice, but on current evidence it is the most accurate guidance available.